Have you ever had $100 in your pocket and wondered how you could turn it into $1,000, $10,000, or even $100,000? Sadly, this isn't something they teach in school, but today, I'm going to simplify the whole process for you. Investing my money allowed me to become a multimillionaire, and guess what I started with? That's right, $100. By taking calculated risks, you'll be able to grow your wealth over time. Remember, as the risk goes up, so does the potential reward. I'll be investing $100 into each one of these options so you can see exactly how to do it. If you enjoy the video, smash that like button, and consider subscribing to grow your wealth. Let's start with the safest option out there, a high-yield savings account. This type of account is designed to offer you a higher interest rate compared to a regular savings account, making it an attractive option for those who want to grow their money with minimal risk. This is a 1 out of 10 on the risk scale, meaning it's extremely safe and secure, so the lowest possible risk that you can have. You can rest easy knowing your money is protected and still earning interest. Now, you're not going to get rich quick parking your money in a savings account, but it is a crucial first step in building a solid financial foundation. It helps you develop the habit of saving and ensures that you have funds available for future investments or opportunities. Why? Because it allows you to build an emergency fund. This fund acts as a financial cushion, providing you with immediate access to cash when you need it the most. This is money you can access immediately in case of unexpected expenses like a medical bill or car repair. These unforeseen costs can arise at any time, and having an emergency fund can save you from financial stress. Trust me, having that safety net will give you peace of mind and prevent you from going into debt. It's a financial safety net that can keep you from falling into the trap of high-interest loans or credit card debt. Plus, with interest rates on the rise, you can actually earn a decent return on your savings. This means your money is working for you, growing steadily over time. I'm talking 4% or even 5% APY at some banks. These rates are significantly higher than what you'd find at traditional banks. That's way better than the 0.01% you'd get at those traditional brick-and-mortar banks. So it's worth shopping around to find the best rates available. So how do you find these high-yield accounts? It's easier than you might think. It's simple. Just do a quick Google search for high-yield savings accounts and compare the interest rates and fees. Many online banks offer competitive rates with low or no fees. Remember, building wealth is a marathon, not a sprint, and a high-yield savings account is the perfect starting line. It sets you on the right path towards financial stability and growth. Gold. It's been a store of value for centuries, and it's still a popular investment today. I'll give this a 2 out of 10 on the risk scale. If you want to stop your money losing value, then maybe gold is for you. Now, there are two main ways to invest in gold: buying physical gold, like coins or bars, or investing in gold, ETFs or mining stocks through a brokerage account. Both have their pros and cons. Physical gold is tangible, it feels good to hold, and you have direct ownership. But you'll need to find a safe place to store it, and it can be illiquid if you need to sell quickly. Gold ETFs and mining stocks, on the other hand, are more liquid and easier to buy and sell. However, you don't have that same tangible ownership. Personally, I prefer investing in gold ETFs through my brokerage account. It's just more convenient and cost-effective for me. But hey, if you like the idea of holding a gold bar in your hand, go for it. Just remember, like any investment, gold prices can fluctuate. Don't put all your eggs in one basket. Index funds are like the superheroes of the investing world. They're diversified, low cost, and have a long track record of solid returns. I'll give this a 3 out of 10 on the risk scale. Think of an index fund as a basket of stocks that tracks a specific market index like the S&P 500. When you invest in an index fund, you're essentially buying a tiny piece of all those companies. This diversification is key because it spreads your risk. If one company in the index doesn't do well, it's not going to tank your entire investment. Plus, index funds typically have much lower fees than actively managed mutual funds. Those fees can eat into your returns over time, so keeping them low is crucial. Now let's talk about compound interest. This is where index funds really shine. If you invested just $100 per month into an index fund with a 7% annual return, then after 30 years, you'd have $123,000. That's the power of compound interest. Now let's talk about real estate, but with a twist. I'm talking about real estate investment trusts, or REITs for short. I'll also give this a 3 out of 10 on the risk scale. REITs are like the cool cousins of traditional real estate investing. They let you invest in income-producing properties like shopping malls, apartment buildings, and office spaces, without actually having to buy and manage the properties yourself. Think of it like owning a tiny piece of a skyscraper or a shopping center. You get all the benefits of real estate ownership, like rental income and property appreciation, without the headaches of being a landlord. And here's the best part. By law, REITs have to distribute at least 90% of their taxable income to shareholders in the form of dividends. That's right, you get paid just for holding on to these investments. Now, like any investment, REITs do come with some risks. The real estate market can be cyclical, meaning prices go up and down over time. But if you're looking for a way to diversify your portfolio and generate passive income, REITs are definitely worth considering. Alright, let's move on to something a little more hands-on: buying and selling items for a profit. This is a fantastic way to turn your hobbies or interests into a lucrative side hustle. Whether you're into vintage collectibles, electronics, or even fashion, there's a market out there for almost everything. This is a strategy I've personally used to generate some serious cash flow, and it can be a lot of fun too. Imagine the thrill of finding a hidden gem at a garage sale or online auction and flipping it for a profit. Now, the risk on this really depends on how good you are at finding great deals, but I'll give this a 4 out of 10 on the risk scale. It's relatively low risk if you do your homework and understand the market trends. You can buy and sell something that you're interested in and have knowledge about, which can lead to bigger possible returns. For instance, if you're a comic book enthusiast, you might have an eye for rare editions that others might overlook. The key here is to find products that are in high demand but low supply. Limited edition items, discontinued products, or anything with a cult following can be particularly profitable. Think about it: if everyone wants something but there aren't many available, the price is going to go up. This basic principle of supply and demand can work in your favor if you know what to look for. You can find these products by scouring online marketplaces like eBay, Facebook Marketplace, or Craigslist. These platforms are treasure troves of potential deals waiting to be discovered. Look for items that are being sold for significantly less than their market value. Sometimes, sellers are just looking to get rid of things quickly and are willing to sell at a lower price. Once you've found a potential deal, it's time to do your due diligence. Research the item thoroughly to understand its true value and market demand. Make sure the item is authentic, in good condition, and that you can actually resell it for a profit. Authenticity is crucial, especially for high-value items like collectibles or branded goods. Then, it's all about presentation and marketing. A well-presented item can attract more buyers and fetch a higher price. Take high-quality photos, write compelling descriptions, and price your items competitively. The better your listing looks, the more likely it is to catch the eye of potential buyers. Chapter 6: Individual Stocks. Now let's talk about individual stocks. This is where things get a little more exciting but also a bit riskier. I'll give this a 6.5 out of 10 on the risk scale. When you invest in individual stocks, you're essentially buying a small ownership stake in a publicly traded company. If the company performs well, its stock price goes up, and you make money. Sounds simple enough, right? But here's the catch. Picking winning stocks is easier said than done. It requires research, analysis, and a bit of luck. Before you even think about buying a stock, you need to understand the company's business model, its financials, its management team, and its competitive landscape. You also need to consider macroeconomic factors like interest rates, inflation, and economic growth, as these can all impact stock prices. Now, I know this might sound overwhelming, but it doesn't have to be. There are tons of resources available online and in libraries that can help you learn the ins and outs of stock investing. Chapter 7: Cryptocurrency. Alright, let's dive into the world of cryptocurrency, the wild west of the investing world. This is a space where fortunes can be made or lost in the blink of an eye. This is a 9 out of 10 on the risk scale. It's not for the faint-hearted. Cryptocurrencies are digital or virtual currencies that use cryptography for security. This makes them incredibly secure and difficult to counterfeit. They're decentralized, meaning they're not controlled by any government or financial institution. This decentralization is one of the key features that attract many to the world of crypto. The most popular cryptocurrency is Bitcoin, but there are thousands of others, each with its own unique features and use cases. From Ethereum to Ripple, the options are vast and varied. Now, I'm not going to lie, cryptocurrency can be incredibly volatile. It's not uncommon to see double-digit percentage swings in a single day. Prices can swing wildly up and down in a matter of hours, let alone days or weeks. This volatility can be both a blessing and a curse. But for those who are willing to stomach the risk, the potential rewards can be huge. Some investors have seen returns that are unheard of in traditional markets. Bitcoin is currently the most popular type of crypto. It's often referred to as digital gold due to its limited supply and store of value properties. If you'd have bought $100 worth of Bitcoin in 2015, today it would have been worth around about $5,000. That's a staggering return on investment. However, it's important to remember that past performance is not indicative of future results. The market can change rapidly and unpredictably. Just because Bitcoin has gone up in value in the past doesn't mean it will continue to do so in the future. The market is full of uncertainties. If you're considering investing in cryptocurrency, it's crucial to do your research, understand the risks, and only invest what you can afford to lose. This is not a get-rich-quick scheme, but a high-risk investment that requires careful consideration. Chapter 8. The Lotto. And finally, we come to the riskiest option of them all, the lottery. This is definitely a 10 out of 10 on the risk scale, and isn't something I would recommend doing. Look, I get it. The lottery taps into our deepest fantasies of instant wealth and financial freedom. But the reality is, the odds of winning the lottery are astronomically low. We're talking 1 in millions or even hundreds of millions depending on the lottery. You're more likely to get struck by lightning twice than win the jackpot. The chance of actually winning is 1 in 14 million, which might sound quite possible, but you're 4,000 times more likely to win an Oscar than win the lotto. Instead of pinning your hopes on a pipe dream, focus on building wealth the right way, through hard work, smart investing, and a little bit of patience. I hope this has taken some of the mystery away from the other forms of investing and made them a little bit more understandable for beginners. Remember, you don't need to be a financial expert to start growing your wealth. If you'd like me to make a part 2 of this video to see how these investments have done over a month, then make sure to smash that thumbs up button to let me know. I'm curious to see how these different strategies perform over time, and I know you are too. Remember to subscribe to the channel and ring that notification bell so you don't miss out on part 2. I'll see you on the other side.